Hello everyone, how's it going? So in this video, we're going to talk about Polestar. It has been a company with a lot of eyes looking at its direction ever since it was announced to go ahead and merge with the SPAC GGPI. The reason why so many people were interested in this title is because many were hoping that the stock would be able to perform miracles, like what happened with CCIV, and even more in the past with Tesla. The heydays of EV might be gone, or at least the peak of the heydays might be gone, but it doesn't mean that the valuations can be lofty, and that the financial market has a tendency to value the future potentials in a very handsome manner. The reality after the merger has been a little bit challenging so far, which has a lot to do with the removal of the reimbursement security capped at a fixed amount for SPAC companies, giving investors a layer of guarantee to limit its downsides. As Polestar has become a regular public company, this guarantee is no longer, and the company will have its equity value floating freely in the same direction as the market outlook, not just for the EV manufacturers, but generally speaking the entire tech stocks. Of course, Polestar remains a serious company, but we shouldn't forget that the central bank's interest rates, real-world events, possibility or the reality of recessions, and the ongoing supply chain issues are all factors limiting the price action from taking off in the short-term future. Now, one of the legitimate questions many people might be asking themselves is if the company has the potential to reach $100 a share. So $100 seems to be a far cry from where it is now. But if we really look at it, ultimately the share price is basically a tiny little slice of a big pie. And the market cap of the company is based off what the market believes the company is worth at the current moment. I think that it's fair to say that EVs are not exactly the market darling like it was back in 2020. However, they're still not valued like car manufacturers, your typical car manufacturers, the Ford, the Toyotas, and the Stellantis of this world. So we do have to wonder if they are still valued as tech companies, and if they are, then it would be a whole different ballgame, right? By the way, speaking of this valuation thing, we should always remember that the valuation is based off the market's perception of what kind of company it is. So the most extreme or the most ridiculous example that I can come up with has been WeWork. WeWork, with investments from SoftBank, has almost succeeded trying to brand itself as a tech company. What do? They actually just sublease real estate, right? They're a real estate rental company. But because they tried to put in so many keywords, like the little buzzwords that VCs like to see, then this is what's going to become like a self-fulfilling prophecy with the market. The market might believe that, oh, it smells like Silicon Valley. It smells like the kind of CEOs who are the mad geniuses, the mavericks, who are time leading us to the land of profits. And they're going to be pouring money into it. And that's how the market cap gets mailed up. So EV has been benefiting from this factor for a long time. But the question is, are the investors going to believe that EV manufacturers are car manufacturers or tech companies? If in the near future this perception changes, or if new technologies become mature, and by new technologies I don't mean new concepts of technologies, I mean the technologies that we've already been talking about over the past 10 years finally maturing so that they can be ready to be deployed to consumers at large. For example, fuel cells, right? So if this kind of change occurs, I think that it's fair to say that the EV market is going to be seriously affected by this. And another thing to talk about is that my feeling is the EV sector is still relatively young, and it's too young for the media to start digging about the other side of the EV industry, which is the materials required to build those batteries. they're extremely polluting and dangerous and radioactive to get them out of the ground. And also the supply chain of those materials, of those minerals, can be questionable, to say the least. So let's come back to the question previously asked. Is it possible for Polestar to reach $100 a share a few years from now? Based on the valuations and the projection of the revenue, yes, assuming that the market's perception about Polestar remains the same. They don't suddenly wake up and say, oh, you know what, they sell cars. You know what I mean? Why would they have this kind of multiplier for their valuation and not that type of multiplier? So as long as this doesn't happen, it is possible. Now, let's discuss about the possibility that this might happen. So I think that at this point, the EV market has too much money attached to it for this reality to actually occur. Like, maybe some people have waked up and said, oh, you know what, it's not really worth that much money, right? It's a bit like WeWork. Oh, you know, it's a rental business. It's not really a tech company. But in the case of WeWork, I believe that only SoftBank believes that. So, you know, that's another case. But in the EV sector, too much money has been poured in for people to collectively wake up now and say, oh, you know what, we've really been played over the past 2 or 3 or 5 years. So this is why I think that this is unlikely to occur overall, all things considered. But it's not 0%. This is a bit like saying, are some companies going to delist from the American stock markets? Well, the probability in the absolute may not be very high for some, but it's not 0. You see what I mean? It's like 20 or 30%, or sometimes up to like 40%. So we do have to prepare for this possibility. This will affect 2 things. Number 1, how much you're willing to invest. And number 2, how long you're willing to hold your position. So in that case, I think that given how EV sector behaves and how the capital flows from one place to the other, I think that, first of all, your position in the EV sector has to be considered as one block. So investing in NIO, Tesla, Xpeng, what are we talking about here? Polestar and Lucid, like those companies, you have to consider them as one single block of risk, of exposure. If one falls, the other ones will not compensate this potential drop down. Portfolio has to be sufficiently diversified in different sectors so that if something happens with the perception of the market, if CNBC suddenly starts to shift their stance, if Bloomberg starts to talk about, oh, is the end of the EV bubble near, right? When you start seeing those kinds of articles, it already means that the end is already here, because this is already like a consensus amongst the professional investors, and they're now just dumping that news on the retail ones. So if this kind of situation happens, it means that it's already too late, and we want to act ahead of the time. So I would say that overall, the exposure in any EV stocks should not go beyond, I would say, 10 to 20%. And for Polestar, I would say that 3 to 5% of exposure is decent enough. The holding period should be between, I would say, 12 to 18 months to give the company enough time to show that results might come or not. But the results might come in and that the stock market can react positively from those fundamental news. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.